Hey, good morning, everyone. I'm Ari Ghosh, and I cover the US exchanges here at Credit Suisse. For our next session, we're hosting a fireside chat with TMX Group to discuss the state of the Canadian markets and exchange trends. It's my pleasure to welcome CEO John McKenzie today. John, I wish we were doing this in person in sunny Florida, but again, really appreciate you being here with us virtually. Thanks so much.
Thanks for having us.
My pleasure. So, let's just jump right in. So 2020 was a disruptive year for global markets, to say the very least, but the operational environment looks relatively improved, early in 2021. So let's kick things off with what you're seeing from a customer engagement standpoint across some of your key segments. Have things returned to normal, or are there specific areas where, you're still seeing some pandemic-related pressures?
Well, first of all, I'd say that the customer engagement, even all through 2020, was really remarkable when you think about how disrupted everyone's business models were. We made a really strong point, and I know they did in the US as well, of ensuring the importance of keeping capital markets open and robust, because quite frankly, we're actually part of the solution on recovery, not part of the challenge. So for the most part, the engagement's been very, very, very strong. Certainly where we saw one of the challenges was earlier in the year about companies being able to come to market and raise money when market volatility was so high. But not surprising, as we've seen in other kind of downturn trends in the past, with that low interest rate environment, with the renewed valuations in the market, we've seen a phenomenal opportunity for companies to raise money in the back half of the year that's continued into 2021. The areas where I would say in terms of where kind of some of those client challenges persist, both through 20 and into 21, is when we're trying to do things that have a high client touch point. So we've been working on building out our Trayport franchise in the US, and while we've got great traction with our partner Nodal, the ability to get in with clients and get engagement done, get installs done, work with service providers, that's been a bit more challenging because everyone is actually just working to try to keep their businesses running. But I do see light on that in 2021. We're going to start to see more progress. Similarly, where we saw things difficult engaging is when you're trying to engage with international customers where you do want to get face-to-face. So in market for our expansion around Asia, I was worried about that in 2020 where we would get back on the ground again, but we have got our folks back on the ground and we're looking to get ready to go live for our derivatives trading in the Asian time zone in Q2. So very positive about how things are going to be for 2021.
Got it. And we're going to hit on some of those points in a little bit, but let's start with your trading business and starting with cash equities. Volumes in the US here were up 50%, driven in part by volatility and also greater retail participation. And, that remains kind of elevated this year as well. You saw similar trends in Canada. So I'm really interested to get your thoughts on the level of retail activity that drove your cash volumes, and if you see this retail boom as sustainable.
So that's a great question. Sorry, I'm already parched to this. So we've seen participation from retail flow go from about 35% a year ago to 45+% today across all our markets. And as you said, very strong uptakes in volumes all through 2020. Into 2021, it has continued to be very strong, and in some cases even stronger, where our senior market TSX, we're up about 33% year to date, but our junior market, the venture exchange, which really does trend more to retail engagement, is up over 80% this year. So really showing that demand for retail fueled activity. And we have hit multiple new record trading days for our venture exchange market through that period. When I think about the underlying trends, and it's not the GameStops of the world, it's what are those fundamentals that are driving the opportunity for more retail participation. We've got a largely work from home culture right now, more disposable income for folks that are working, retail access in a way they've never had it before in terms of both trading tools, access tools, disclosure and dissemination of information. So the ability for retail to participate is as high as it's ever been, and that's continuing. And then when you couple that with a very low interest rate environment, which means two things. One is, cost of borrowing or cost of credit is low. The ability to get yield in the debt market's not there. You've got to look to the equity markets. And the corollary, strong equity valuations make that market good to invest in. Those are all trends that are going to continue for the time to come. And while there are challenges with this kind of activity that we're seeing in some specific names, I don't want to forget the upside, which is the more retail participation we've got in terms of strong valuations, the more we can have small companies come to market because they're able to do really good equity capital raising with this level of participation in the market. And that's a good thing for market integrity.
Yeah, no, that makes sense. And are there any specific company initiatives that you've undertaken to sort of capitalize on this growing retail segment?
It's more about the ability for us to support the market no matter what it's doing. So we've been working on about a year and a half program around modernization of our equity platforms to really make them more robust, more resilient, able to handle larger swings in volatility, and the messaging traffic that comes with this renewed interest. So that's our focus. And sure, we've got all the infrastructure there to support whatever the market wants to do. The other area for us that it's more when we think about options, US options has been on fire through this period. And while the Canadian option market has been growing, I think we're up about 20 points this year, it hasn't been as well embraced from a retail trading activity as it has in the US throughout the years. And there's some structural differences around licensing of agents, around access to product. But what I hope to see here, we're going to continue to push on education initiatives. The demand for retail, I think, will drive more dealers, more banks to provide access to these products to retail traders. And I think that'll be positive.
Got it. I think that's an interesting point. We're going to touch on that next, sort of moving to the derivatives business, maybe just starting with, the outlook over the next 12 months for your interest rate derivatives, where the macro backdrop has improved a little bit versus, what you saw towards the second half of last year.
Yeah, and certainly, and even in the back quarter of last year, we were starting to see that sequential growth happening again month by month. What we've been doing in terms of supporting the market, but also adding product is what's going to help us long term here. So the interest rate market that was so depressed with this low rate environment, always believe that while that can depress your short term products, it doesn't mean necessarily it's going to depress your long term products. So we've been focused on getting more product across the yield curve for traders to trade against. So we actually, in the middle of last year, in the middle of the pandemic, we actually relaunched our short-term 30-day product. So a new short-term product that's got a better benchmark. We added a 2-year product in December of last year based on client demand to do that. So you can think about that. So even though the market has been depressed on the short-term curve, clients wanted to see us with a 2-year product on exchange. And so we were able to launch that in December. We've already got a very strong 10 that's been recovering really well. I think we're up another 20 points roughly this year so far. We've been getting strength in our 5-year product, which was one we relaunched a couple of years ago. And we've got client demand for 30 years. So the demand indicators are there to provide support to that curve. And then the work, as I indicated earlier, that we're working on going to Asian time zone as well. We're already open from 2 a.m. So we trade European time zone. And that actually helped in 2020 because even though volumes were depressed, we got 6 to 10% of our flow coming out of that time zone trade that we wouldn't have had 2 years prior. So we actually got some offset to some of that pressure. So we are looking to get out into the Asian time zone in the second quarter, which will then kind of catch us up to the other global exchanges to be able to trade virtually around the clock.
Got it. And I think that's a good segue into my next question, which is more on the broader derivatives industry and some of the trends that you see there. So across equity, index, rates, what's sort of the industry growth outlook for the segments as you kind of consider product maturity in Canada? And then, when I think about these segments, are there particular spots where you see more growth opportunities, either through, product development, globalization of the base, for example, or something else, to your point with the options market seeming to be at different levels at, Canada versus US as well?
Yeah, so globalization absolutely is going to be a growth driver for us. We've got about 40% of our flow coming from outside of the Canadian borders versus most global exchanges that are closer to 60. As I said, on the time zone trade, we're doing about 6% right now out of the UK. Mature platforms will have 15 to 30% of their flow coming outside their normal time zone. So those are all indicators of growth potential that we're trying to capitalize with the geographic solutions, which is not just time zone, it's actually time zone access, clearing capabilities to make it easier to trade from different regions. So it's all in the plumbing that goes with it, not just when you turn it on each day. As you indicated on the product roadmap, now that we've got all the different components that we're looking for on a yield curve, it's going to be about marketing those products to clients to get the liquidity built into them, and then liquidity can beget liquidity to build them out, and people can then trade across the curve. So there's some maturation that's got to happen to those products. You don't just put them on the market and we're done. We need to build them out. On the other piece of the product curve, a couple of neat areas that we're focusing on product development. One is clearly around interest around ESG. So with our partnership with S&P, we have launched ESG tilted indices for both the Canadian composite for the 60. We've got futures that we've launched on those now as well. We'll be looking for additional product in the future, and that gives people a different lens of the equity complex that they want to trade for Canada. And we're also looking at different types of products around the equity complex. So dividend-based futures, other futures on single names. We are one of the few markets that does single name futures. So we can, when you've got either a stock or an ETF that's very hot, we can put a future on that so people can get future exposure to it. And those are all things that we continue to build out. One of the other areas that we've worked on, and we think that will be part of our long-term focus, is global product. So everything we've talked about has been Canadian-based product today. We've got an index product for global cannabis because that's a market that's starting to develop globally with different companies around the world. So we are going to look to that for where Canada can be a source of strength for a global index, and then we can provide futures on that. And that'll be easier to develop once we're also built out on the time zone trade so that people can trade these things around the clock.
Got it. And then some of these new products, especially cross-border and global, is that, just new sort of first to market products versus a flavor of something that's already there, or is it a mix of the two? Because I would imagine that, especially in the derivative side, either you're coming up against already established products or exclusive agreements with some, index providers, things like that. So is it primarily on the newer development of products when you think about non-US?
Yeah, it's on both. Because in some cases we can see what products other markets have been successful on and create a Canadian version of it for the Canadian assets. So sometimes it's great when you actually can see what's already been successful in other regions to build from, because there'll be investor demand. The other place that we do focus on is where do you see liquidity in the over-the-counter market that can be serviced by an exchange alternative. That's what we did with the 5-year fixed income. That's what we're doing in the 2-year as well. So you're looking at, again, where is there known client demand that we can solve a problem for?
Got it. And then maybe shifting gears to capital formation, you talked about how robust that was. Again, a really strong year for you with listing activity sort of surging in 2020. I think you added 276 new listings across your platforms there. So curious what the pipeline looks like in 21. Do you expect this momentum to sort of continue through over the next 12 months?
So I'm going to be careful about predicting 12 months of the future, but I don't mind predicting a few months at a time.
That's right.
Even coming into this year, I believe we've had 29 new listings already this year through January. So that trend has not abated at all, and it continues to be driven by a lot of demand in tech. We still have strong demand in mining as well, in terms of both base metals and rare earth metal companies. Those are all exciting sectors that keep pushing ahead. Our team, we have two lenses in terms of pipeline. One is our sales and business development side, which is more of that long-term lens of the companies that we're curating over time that could be potential public companies in the future. And we've got an active pipeline of 1,500 companies there that we get into dialogue with, of which half are tech companies that could potentially access the market for capital in the future. But you can't definitely predict when they will want to access the market. It's more about continuing to sell the benefits of the public market. So when they do need capital, they are thinking about the exchange as an alternative and not just the private equity market. Right. In the short-term pipeline, we get good visibility to it because it's our people that are working those files. So even though that this is our people are actually all working remotely, we've actually digitized this workflow so it can all be done through remote work tools. But we see that file load of companies that are coming to market, and it continues to be very robust. We've been adding resources as a team to help deal with the demand, and it's the heaviest demand we've seen in a decade plus.
Oh, wow. Okay. That's helpful there. And maybe on that point, before we move on, I wondered if you could talk a little bit about the mix of companies that you've recently seen that have been active on the IPO side of it. Has there been acceleration more towards your venture and tech names? Has there been a skew over there in terms of the ones that came to market and the ones where you've seen market cap grow? And if so, I was wondering what the implications were for your, in terms of business opportunities, either from new indices or corporate solutions, new business opportunities as a result of sort of this evolving landscape of active companies?
Yeah, that's a great question. So from a sector standpoint, certainly the biggest two drivers have been innovation companies and mining and resource companies. The largest two deals that we've done this year have actually been some of the largest in history for us as well. So TELUS International is the largest tech IPO we've ever done. That went in January. Topicus.com was a spin out. That's the largest venture listing ever. So we've actually it's been broad based in terms of both small cap on venture and large cap names as well. Tech sector very strong, resource sector very strong. Tech sector, for one, is one that we've been working on developing for a number of years. So it's topical now, but it's something that the business development efforts have been there for a number of years. And we identified it as an opportunity in 16 that we wanted to see if we could build a tech franchise that was big as rivaled our resource franchise that we were historically known for. And since that time, we've grown from about 5% of our mix in terms of TSX venture companies in tech to about 14% today, and resources about 19. So a real substantial closing of that gap. The one sector in the resource side that continues to be challenged has been the energy sector. And that's been a global challenge around energy names, but we have seen some signs of light in it in terms of gas companies that have been able to raise capital through this period and other companies that are testing the market. So there's been some broad-based interest in that and industrials as well, but those have been the two sectors that have really driven it the most.
Yeah, that's another good segue into sort of the energy side of it as well. So just moving to your global solutions and analytics business there, and starting with Trayport. I think there again revenues have been growing above your high single digit targets. So despite the pandemic and some of the pressures you saw there. So again, can you talk about sort of what's been driving the growth and the sticky demand here, despite the pressures that we saw last year?
Yeah, and certainly last year, our concern was the energy sector under stress. What would that do to client health? Would you get the client renewals? Because this is a subscription business largely. And what has played out has been quite the opposite. The Trayport solution does such a good job of aggregating markets for clients and giving them full visibility that it really shows how indispensable it is for clients. So our renewals through 2020 all continue to be robust. Clients that are renewing with us for multiple years, there's premium in them. And we're also adding new services to the clients at the same time. So throughout 2020, we acquired one, and we built another new product. So we had an algorithmic trading solution that we acquired and then integrated into Trayport. We built an analytics solution. These are now premium offerings that we can push out through Trayport as premium subscriptions, and they increase that revenue per user, and they increase the client experience as well with the platform, because now you can do more data analytics on the tool in addition to the marketplace aggregation. All those trends are positive as we go into 21. So the continued demand for global natural gas, for electricity, particularly continued growth around renewable electricity, has been part of the pieces that have brought more traders into the community, and those demand curves continue strong. Those continue to be double-digit growth areas in 2021 in terms of the trading activity across those products. When we couple that with the things that we can do in terms of building out organically as well, we are looking to other marketplaces where Trayport can be a good solution. So this is the U.S. market that's got fragmented power and gas trading. Trayport is a good solution for it because it can bring that together on a single screen. So we're going to keep working on that build out as well, and it'll continue to help support that long-term growth target.
Got it. And that you've got a strong presence in Europe there. In terms of some of the secular tailwinds, I think you touched on a couple of them, but I wanted to just drill down a little bit on the secular tailwinds benefiting Trayport, like from liquid natural gas to algo power trading? Are they some of these longer term secular themes that you're sort of positioned for? How should we think about that? And then maybe if you can just remind us again, who are some of your largest competitors in the space as you think about growing the business and expanding it?
Yeah, so like you said, the liquid natural gas, one of the contracts you use as a benchmark for that is the TTF, the Title Transfer Facility product. That volume, that one is up 27% last year. So there continues to be growing demand for that. And we're going to continue to see more of that as LNG allows for pricing around the world to be benchmarked off of different regions. On the renewable side, the short-term power market, we look to a contract called the EPEX spot. Because what folks may not realize in the power trading market, when you tilt your power trading to be more renewable, you need to be trading more in the short term of the curve versus the long term, because the wind blows at different times and the sun shines at different times. So you need more spot trading solutions. So EPEX spot trading is up about 14% over that period. So continued growth in demand for those products as well. The pieces around that make that interesting is that as you bring new traders into the mix, they don't just trade these things, they trade other things in the composite around energy as well. So what we're also getting is we're getting interest and demand for refined oil products on one end, where folks would like to see that on a liquid screen because a lot of that's traded bilaterally today. And we're also seeing demand for renewable energy and renewable energy credits because it's the same clients that want to trade those things as well. So we are looking at other product opportunities to continue to expand. Now, the latter part of your question around competition is, it's interesting because it is a unique platform. So there isn't another platform like Trayport that aggregates all these marketplaces in terms of brokers and exchanges onto a single screen. Often what we're trading on or competing with is in-house solutions. So when we're talking to a broker about putting their product and their volume on our screen, it's about using our screen instead of doing their own. So it's in-house solutions. And on the other end, for highly liquid product, it's the ability for clients to go straight to exchange. And so that's an area where we don't really look to compete. So I'm not going to compete for WTI trading in the United States. That's well served by ICE and CME, and aggregating that isn't going to create value. But I can create value by aggregating all those other different types of oil trading products that are more disaggregated, and we could provide a central solution for.
Got it. No, that's really comprehensive. Maybe taking a step back and looking at the competitive landscape. Can you talk about whether the broader what kind of competitive pressures you're facing in the Canadian markets right now? If you're seeing either an uptick in pricing pressure or concessions that you offer as a result of new competition, and also as you continue to gain wallet share, so it works both ways as well. Has there been any acceleration in either pricing pressure or concessions that you've been having with customers?
Not so much in that sense, because I think in the areas where we're seeing a lot of volume, the customers are also doing very well as well. In our marketplace, in the Canadian market, we've got about 14 different venues that trade our securities. Of all the trading across those venues, we operate 3 of them. We've got about 67% of the market share trading in our listed names. And that's been fairly steady. In fact, in 2020, where we were actually up a couple points in market share as opposed to the increased volumes creating market share pressure. And within the mix, where we're actually performing really well is in things that, in some of the added product we do. So we actually offer dark trading on exchange. So we've got dark tools that compete with dark pools. And we've actually been gaining market share in those places. We've also been working with the industry on reforming our market on close facility, which should add for potential new liquidity in the closing facility as well. So we're competing quite robustly there, but we know you never take it for granted. You got to keep working on your product set, ensure the pricing is competitive, which it is. We also made a strategic choice a number of years ago that was we would only trade the names that we listed. So that also helps on the market share around listings. So we see very few companies that will list on another marketplace that meet our standards. And if we do see ones on other marketplaces, we do actively sell them to move them across, both domestically, and we also look internationally as well. So companies that would potentially be Canadian and would bypass Canada and go straight to the US, we always look to engage in those to ensure they see the value of a Canadian listing and accessing the Canadian capital base. And that's an area where we see very few companies bypass us.
Got it. And then, I'd love to get your thoughts on sort of the broader competitive exchange landscape and dynamics, Canada versus US. What are some of the key differences that you see? Is it market fragmentation, market share sort of dynamics over there, exclusive agreements? Like, what are some of the key differences that you kind of see between the two markets?
I mean, you got to start with the size. That's the elephant in the room. So the Canadian market is a smaller market. So when you add a lot more players to it, there just simply isn't the same amount of liquidity to fragment. So I think it's more challenging for small players to get traction that way. So even though the regulatory regime makes it very easy to add new marketplaces, you got to get critical mass to be valuable. And we do have a regulatory threshold that you've got to at least have 2.5% of marketplace, 2.5% market share before people have to connect to you and look at your market. So there is a threshold there. I'd say one of the bigger difference though is that the United States got a much bigger regime around payment for order flow, and you see that with how that supports different retail platforms and firms that will buy their flow. The Canadian market doesn't have that regime, so it is much more of a natural flow coming on exchange than being internalized in other flow buyers' portfolios.
Yeah, I think that also interplays into sort of the on exchange versus off exchange delta that you see in the US versus Canada, where off exchange is still small, right?
Yeah, very much so. I think our total mix of dark in Canada is probably about 10%,
10-ish, yeah,
30-40 in the US.
Yeah. Maybe shifting gears and to sort of these emerging industry themes, and you mentioned it earlier as well. So I want to touch on ESG first. Clearly, this is one that you have several key initiatives already underway. Both across sort of issuer services, reporting, sustainable bonds, ESG indices. Like, it seems like you're doing a lot here. Can you talk about sort of your expectations around this theme, which seems like it's really here to stay, and how TMX is positioned relative to industry participants for this whole ESG proliferation?
I think we're positioned really well because when you think about the mix of issuers we have, in the Canadian market, we've got about 2,500 public company issuers, from very small stage to very large. But it's only those very large ones that have the in-house capabilities to navigate the ESG landscape independently. We've got a lot of small companies that really could use support, that they don't understand what the standards are, who they report to, what these different type of investors care about, which is why we built out the ESG 101 capability, so we could really act as a partner to the issuers to help educate them on ESG investing, on the different types of standards, on what the different ratings mean, and how they actually can put out better disclosure. That's an area we're going to continue to build on. So we are looking to how do we actually help create reporting solutions to make it easier for issuers to report through us, and then we can provide that data more readily available to investors. And it really is, it's trying to solve for this problem of the fact that there are standards, but there isn't a standard.
Right.
It's very challenging for small companies to navigate.
Right.
That we see as part of, how do we continue to create value for those companies and make it easy to be a public company so that more companies will want to list with us.
Mm-hmm.
The other side of the commercial side is how do we really provide those products and services that investors are looking for? And you hit a couple of them. So we're working with S&P, our index partner, on creating more ESG-based indices. Those are available then for creating ETF product or other mutual fund product on them. We've launched the futures ourselves on those programs as well. We're going to continue to look at what those product opportunities around it. And then the one that you talked to as well about the Sustainable Bond Initiative, that's a unique one for us because in North America, you don't see bonds traded on exchange. So this is a program that we're working through with our regulators now to actually be able to post sustainable bonds that are government issued or quasi-government issued on exchange for both institutional and retail traders to interact with. So I see it as not just a solution for the marketplace, but it's also a test opportunity to see what kind of engagement we can get in a different type of product on exchange. Yep.
No, that's interesting, and that sort of brings up the next one where I think about white spaces in this ESG landscape. Curious where you see the most opportunity. Is it more on the issuer and corporate solution side versus trading of products versus index and data? So if we just put those three big broad buckets, maybe they're more. Where do you see the most white space for the exchanges to kind of operate?
Candidly, I think you have to do both. You cannot be relevant on the product and service side if we're not doing the right things around helping the issuers navigate and report. So that's a part of being a relevant player here. From an asset, when you think about it from where the asset management side is going and the gross and assets under management that have got an ESG tilt or an ESG exposure to it, that's going to drive incremental demand for trading product, for derivative product, for index and data and benchmarks. So all those things are going to be having areas where we're going to have increased demand.
Got it. I don't know if you put out, any commentary or numbers around it, but is there a sense of, sort of the TAM that you're attacking on the ESG side, where you think it can grow over the next, 5 years, 10 years, whatever sort of high-level thoughts you have on it?
I think it's table stakes. This is where the investing community is going. So companies need to be able to report beyond just traditional financial measures. They've got to be able to give it a lens into these other important stakeholder metrics. So I really see it as part of table stakes of how our industry is going to transition, as opposed to being it a net new asset class. Got
it. No, that makes sense. Maybe moving on to crypto and digital assets, which is another clearly, it was a pretty robust topic, just given what was going on in the industry. I think you guys also listed the first Bitcoin ETF. If that's right, I think that was lifted there. I'm curious what your outlook for the whole crypto and asset tokenization is, in the coming years. And do you think that 2020 was sort of a tipping point in terms of broader institutional interest and engagement?
And so that's really the key to the question, because where we take our approach is, what do our clients look for us to do here? And so how do we support the industry and as both not just the institutional interest but also the dealer interest gets more engaged in either trading or supporting these assets, we've got the ability, as you see with the Bitcoin ETF, to put things on the marketplace that give people the access to. So you think of the other levers that we've got. We've got the ability to create index or data product here. We've got the ability to create futures product to be able to trade that exposure as well, if the client interest is there to support it. I think the Bitcoin ETF is a really good example of the retail demand for that product made that a good lead horse in terms of bringing that onto the market. And I'm not surprised that we were actually the first exchange to do it, because I don't know if you know that we were actually the first exchange to do ETFs in the first place. We actually were doing them 30 years ago, 10 years before they actually came to the US market as well. So it is an area where we've been innovative in the past. So I'm glad to see TMX continuing to be at the front end of that. I think it's a really good product when you think about retail investing, because the challenge for currency and cryptocurrency has been access, and all the challenge of retailers getting in and out of it. What's the actual liquidity? What are the transaction costs? What are the hidden costs in doing that? And when you put that into an ETF, it's transparent, it's clear, it's accessible, and it's being traded on a market that's got integrity. So it's taking something that was a bit in the dark in terms of trading parameters and putting it under the full light. So I think these are great products for retail investors, and I think you'll see us do more of it.
Got it. So that you already have regulatory framework around retail products and how it's viewed from a regulatory lens right now, which I would imagine makes it a little more easy for at least institutions to engage. If I think about it, and I think that's like the big hurdle in the US right now, before you see that broad-based adoption, because you need some kind of regulatory framework before both the institutions kick in and you have some cross-border usage as well. So it seems like you guys have at least something in place there.
Yeah, I think you're right.
Got it. Maybe on a similar vein there as well. I've got some calls around, asset tokenization. People have been talking about, either using blockchain on some of the more esoteric sort of, gaming tokens or art or some of these, less tradable items. Love to get your thoughts on what you see. Do you see a future for, more tokenized assets outside of some of these esoteric places where, maybe it'll be bonds and cash equities and options? Could that be something that's a big disruptive element to current exchanges, clearinghouses, and the way markets operate right now?
Yeah, it's such a good question, and it's something we've actually spent years working on. So it's not a new phenomenon. We've been looking at blockchain, distributed ledger, tokenization technology for years, and actually, 5 years ago, determined that the right path forward on our clearinghouse technology was not to go there. It was actually we're actually finalizing the phase of installing new modernized clearing architecture that's still on more of a traditional database, because at the end of the day, for the broad-based trading of equities and clearing, that technology isn't solving a problem for anyone.
Right. Right.
We actually, there was lots of chatter around Robinhood and GameStop around settlement cycles, but we've got technology that can settle same day or real-time settlement on existing database structure. I can do it on our 20-year-old mainframe. So it's not a technology challenge that's solving those problems. And when it comes to the high-speed trading of equities and fixed income, you need technology that can operate in a high-speed environment with quick settlement. So that's one I don't know that's fit for purpose. I think on the first piece is whether or not some of these more niche type products where complex securities could become more mainstream with distributed ledger capability. That's really there's client interest in those types of securities in a broad base.
Right, and I think that's the broader sense too. Like, you're not going to change infrastructure, market quality where things are already working to find something that really isn't. There's not an evident problem as such. So those are great thoughts, and it was interesting. We've got a couple more minutes. Maybe talking about maybe one final topic around your M&A strategy and capital deployment. If I think about the exchange landscape, M&A has always been a big topic that that continues to be pretty relevant into 2021 as well. How do you look at opportunities either to add product or global scale for TMX, and kind of balance that against a lot of the organic initiatives that you clearly have in place and strong market share kind of positioning as well. So how do you sort of look at these two elements while thinking about M&A?
Yeah, I mean, that thought around M&A is completely driven by our strategy. So our growth strategy that focuses on continuing to grow Trayport and our data and analytics, our capital formation business in terms of broader reach to issuers, but also deeper services to issuers, and continuing to build out in our derivatives franchise. So when we focus on what those M&A opportunities are the ones that can help accelerate the strategy as opposed to change the strategy that we're in. We've got an opportunity that we're working on closing now around AST Canada. This is a trust company that allows us to provide deeper services into the biggest issuers in the country and continue to create a stickier relationship with issuers. So expect us to keep doing those types of things.
Mm-hmm.
We're looking at other analytic tools and data products that we can bring into both Trayport or into our more traditional data business that we can then bring in and scale up. You saw us do that with Visotech, the algorithmic trading solution that we bought for Trayport, and scaled it up. We're going to continue to look to do more of those things. But let's call it on the table. Valuations in the marketplace are challenging right now to do deals that make sense for investors, and our investors should expect that we're going to keep their interests at heart and ensure we're doing things that create value.
Oh, that makes a lot of sense. I think with that, we're pushing up on time. I know you've got a bunch of meetings as well, and in this virtual environment, there's not a lot of lag time, I guess. But John, thank you so much for joining us this morning. It was an absolute pleasure. Great chat, and everyone else on the line, thank you so much for dialing in virtually. Have a great one, and we'll chat soon.
Thank you so much. Much appreciated.
Got it. Bye.